Today we want to talk about the differences between a HELOC and a cash out refi and what you need to know before you decide on either one of them. What's up guys, it is Ryan.
And I'm Neil.
From Premium Mortgage, and today we had a client that called us and they were inquiring about the difference between a HELOC or a home equity line of credit and a cash out refi. So what Neil and I wanted to do is just cover some of the things you need to know about both products, and you may feel one of them is better for you, but give us a call and we'll help you figure that out based on your current situation. So first, let's talk about a home equity line of credit. Neil, tell them what a home equity line of credit actually is.
A home equity line of credit technically is a second mortgage. Like people will say, I don't have a mortgage. Do you have a HELOC? Yeah. That is a mortgage. It's a second mortgage. It's going behind the mortgage you already have. Technically, 9 out of 10, almost 100 times, they won't lend up more than 80% of the value of your house. So take your house, $500,000, what's 84, and you owe 3, they're gonna lend 100, the difference. They're gonna lend 80 minus your first. Also, usually a HELOC, as you pay it down, you can take it back out again, and your interest rate fluctuates. 9 out of 10 times, it is not a fixed interest rate on a HELOC.
So in today's current times, is it a good thing or a bad thing if somebody's looking? Is it a good time to get a HELOC? Or with the trend that we're seeing where rates are going up, could that make it a dangerous time to get
a HELOC might be okay today, but in another 6 months, because usually they adjust in 6 months, that rate might be 7-8%. Not only that, people like HELOCs because they're interest only, but what good is it? You can be paying it, and I'm saying this from somebody that did this, paying interest only for 10 years and still owe the total amount that you borrowed.
Which is kind of crazy, guys, because if you think about it, and I always say this, interest is the cancer of your finances. If you're paying it, that's bad. If you're collecting it, that's good, but if you're paying it, that's not so good. So looking at a HELOC, it's a second type of it's a type of mortgage. It's typically a second mortgage on your house. So you'll have the primary, which is the principal balance. You'll have the home equity line of credit, which is a percentage of it.
2 separate payments.
2 separate payments, right, which will show 2 separate accounts if you have your credit run. Let's see, you're only paying interest Neil used. Now, if let's say you have a HELOC, okay, but you're not using any of the money. Let's just say they conceptually give you $25,000 on the HELOC, but you're not using any or you're not borrowing any of that money, then you're not paying interest on that money. It's basically just kind of like a credit card that you're not using. It's just sitting there. The limit is there. If you're not using it, you're not paying interest on it.
But there is a second mortgage. Like correct. You can get a HELOC or you can get just a second mortgage where they give you the total amount and you have set payments for a set length of time.
Correct. What Neil did mention is that the rate is adjustable. What I didn't know, which I thought was really interesting, is that they do regular credit checks. So let's say you have a home equity line of credit with the bank. Just like, remember, credit cards pull your credit. Most banks will pull your credit every 14 days. Most people don't know that. I didn't know that at first.
I didn't know that.
Every 14 days, a lot of banks, like especially American Express, they will internally do a soft pull, which is why when you log into your portal on your phone or on your computer, it'll say, hey, do you want to see your credit score? Do you want to know why? Because they're monitoring you every single week and every single month to make sure nothing's changed or nothing's going crazy on your credit profile.
Because if it does, they're going to shut you off so fast.
Exactly. Talking about a cash out refi, what you need to know about cash out refi is this. Number one, if you're going for a conventional mortgage, a cash out refi rate is typically going to be a little bit higher than a regular rate and term refinance. Okay? If it's FHA, Neil,
yeah. They don't care. FHA, 80% LTV, rate and term or cash out, the rate's the same.
Right. It's a fixed rate. So unlike a HELOC, this is going to be a fixed rate. So whatever it is, for example, today somebody was saying, I'm looking at buying another property. And what she was saying was, I'm thinking of getting a home equity line of credit, and then after a couple months or a year, I'm going to then do a cash out refinance, pay off my first and my HELOC, and then just have one regular rate. And I said, well, that might not be a good idea. And she said, why? I'm like, because rates are going like this. Now, granted, they're here. And right here is pre-pandemic levels. So they're actually back to where they were. So rates right now are still okay and good. They're not bad. If they continue to go up like the Fed is talking about, that's when the rates could be a little bit more pricey than where they were back in 2020. But the idea behind this, guys, is to realize this is fixed. So you want to get it now. If you're going to do it here now before it goes any higher. Okay?
Not only that, you can always get it today, and 2 years from now, if rates come down, you do a refi. When you get that home equity line of credit, that's usually adjustable. You don't know where that's adjusting. And then let's say you do want to do a cash out refi. You got to qualify. That means you have to still make the income or more income than you're making now. And your credit has to still be good. So if something happened, you lost your job, or anything could have happened, you might not qualify for that loan.
Yep. So these are all different things, and obviously when you do a cash out refinance, it's amortized over 15, 30 years, whatever it is that you choose. There's many different things you want to look at, but guys, really the difference between the HELOC and the cash out refi is this is now, you're locking in now. This is a variable product. You don't know where it's going to be.
This looks good on paper originally, but 5-6 months, because they're adjustable, it's going to go crazy high. And it's just the way it is.
Yep. So hopefully that was helpful for you guys. If you have any questions, if you're thinking about it, give us a call. Again, we won't pull your credit. We'll run through the scenario. We'll tell you what we feel is best based on your scenario, and then you can make an educated decision once we've discussed it. Okay? But don't waste time right now. Again, we were telling people, in fact, I had another borrower who just sent me a text message. I followed up this morning. I said, hey, how you making out on the home prices? She goes, I am so sorry I didn't listen to you 3 months ago when you told me rates were going to go up and it was only going to get crazier, because it has gotten a little crazier. It's still a great time. Guys, they're still projecting the next year everything's going to go up in value.
Here's the best one. Don't rent for another year. See if you can just make your lease a month longer, 2 months longer. If you don't get in now, you might not be able to get in later.
Yeah, there's a lot of people pricing themselves out of the market. We've already covered some videos on that. But again, if you have questions, call us now. Don't hesitate. Don't put it off for another month. Give us a call now. Let's figure out if it makes sense. If it does, let's lock you in right here, right now, before things go any higher.
We won't pull your credit.
Yeah.
So don't worry. Just call and talk.
Yeah. You guys have an awesome day, and we will catch up with you later.
Thank you.